Hey, what's up, traders? Today's Tuesday, October 13, 2015, and this is Trader Tim from E-mini Mind bringing you another market analysis video. The first thing I want to talk about today is being Tuesday. We've got some earnings announcements that are coming out throughout the week in the next couple of weeks. Some of the bigger players, so keep an eye on those if you are trading the stocks. But also, as we kind of keep an eye on gaps in the morning, because a lot of times when we get these earnings plays or these earnings numbers coming out after the market's closed, it can kind of push the market to gap open, or gap up or down rather, at the open. So we can look for a gap fill, which is when we gap and trade towards the prior day's close, or we can look for a gap and continuation, which is, for example, today how we closed down. Tomorrow, if we gap down, a continuation would continue us lower. And so that's kind of what I want to talk about first, is with this bearish candle that we formed today. Yesterday's candle, not really that important. It's an inside bar, meaning the high and the low are within the prior day's high and low. So that really doesn't mean a whole lot in terms of forecasting anything. But what we have here, not only did we break today's high, but when we did that, we immediately sold off and traded down below the low from 2 days ago. So we had the opportunity for bulls to push us higher. We broke highs. We made a new high in the day, but the buyers, or the bulls, weren't able to sustain that, and the bears took over, or the bears gained control and pushed the market down to make a new low on the day and break the low from last Friday. So going into tomorrow, I would look for a gap down on the open with a potential continuation, because we're at the initial new trend direction, meaning we were trending up, and if we do gap down at the onset of the downtrend, there's much more likelihood for us to continue that gap, continue that trend. So if we do trend lower tomorrow, I look for a move down maybe to this 1955 level. But more importantly, if we open up lower, I would look at the first 5-minute bar, or even the first 15-minute bar, to wait for that low to get breached to kind of jump on to the trend, versus just seeing the market open and get in. A lot of times, you'll get a reverse move in those first 5 or 15 minutes. You kind of want to let that settle, because what can happen is if we gap down tomorrow, and then the first 15 minutes we, form a candle, either lower or higher, sometimes that first 15-minute bar, if we're going to fill the gap, that could end up being the low of the day. And if it is, and you put a sell stop below lows, and we start moving higher, and your stop is never hit, so that you never get into the trade, well, then no harm, no foul. Versus letting the market open up and immediately getting in because you think the market's gonna continue lower, and then you end up selling at the low of the day, and then starting out with a loser right off the bat. So while I do think a gap down is likely tomorrow, as well as a continuation, I don't want to just kind of, sure, that's a scenario that could happen, but I don't want to really act on that until I see some conviction or some follow through in the market. And that's kind of the whole premises behind the trading philosophy at E-mini Mind, like waiting for that conviction, or waiting for some sort of signal to allow us to act, versus just having a theory or an opinion and just acting on that. So trying to be a little bit more objective. The flip side of that is, if we open up in the middle of the range and break highs, we are pretty close to the 2018s, and that would be the failure of the 61.8. And if we do break highs, I would look for us to come up here to 2035s and kind of make a move to prior lows. So I think tomorrow is going to be a very critical day. Not very likely that we be an inside day and just not move above highs or lows, just because it is a inverted hammer. Um, so yeah, and some important things to just kind of be thinking about as we open in the morning. There's a lot of news announcements, both economic data and earnings announcements. So a lot of catalysts that can push the market. And once we get going, especially right now we're at highs relative to the recent rally we had, and looking for this to kind of be the initial or the start or the onset of a big move lower is pretty likely. So you know considering both scenarios, a break higher and a break lower, I would be ready for both, but certainly a move lower has a lot more room to fall quickly is I guess my thought at this point, just because once the bottom falls out, now that gives a lot more conviction to this 1982 level, even though we broke into it, and we can trade back down even 100 points really quickly. So with that, I want to move over to the euro, and we talk about both the bigger picture and then looking at the smaller time frame, and make my window a little bigger with these new charts. It's a little hard to maximize the window by the double click. Here we go. Come on. Well, I'm just going to leave it with both windows up for right now. So I wanted to first take a look at the euro on the 512 tick chart here as a kind of macro daily picture. And as you can see, not a very clean chart in terms of, yes, we're just moved sideways, but there's a lot of one bars that are one color and then another bar that's another color. You get into this kind of thing where you get a couple green bars, a red bar, a couple green bars, a couple red bars, versus these nice smooth trends. And I've got the 5-day up. Let's see if I can just go back to a little bit, versus back here where you get a little bit more, visually trending action. It's starting to make itself known back here that there's a little bit of choppiness where you get green bars, red bars, green bars, red bars. But for the most part, earlier last week we had a little bit more trending action. So coming into today, looking at the smaller time frames for some actionable day trades, we've got these single bars that it can be fake outs, can be just a little bit of noise. But when we get in these situations here where we've got a 1-bar pullback, essentially, meaning just the 1 bar is red and then we get a little rally. Sure, we break down from lows and we broke the swing low, but it's nice to see at least a couple bars. And so then what you get is this kind of a scenario where, okay, you can, obviously the setups here, even if you're just taking a look at from the opening low to highs, like, you still get the pullbacks and the nice moves, but when we get into these choppier situations, they're not as clean. They don't go straight to the target. So we, let's say you use 1400 as your entry and put your stop up at 1405s. The trade ends up working out, but in the middle of that, it's easy to go back here and say, okay, yeah, we did go entry to target, but how did we get there? And if we look here, we broke down, and whenever we break, in this case, the anchor point, either breaking down or breaking out, I do like to, start thinking about tightening my stop a little bit. So you can do that in a couple of ways, by either trailing the 512 tick candle, which in this case would have pulled you out at about 97s. But the other option is to trail every little swing high. So let the market get a little bounce and then sell off again. And so, the initial stop above highs, above the 61.8. The second stop, you can drag it down, or you can drag your stop down to this 98s once we get the pullback and sell off. And then once we break lows again, just wait for another bounce. And in this case, we trade it down to the target. But you can just see how it's a little bit choppier on the way down on the way from our entry to our target. So you can use the patterns that we're seeing in that when we get, a couple green bars, a couple red bars, maybe 4 or 5 bars in one direction and then 4 or 5 bars in another direction, and then these single prints where you get these single pullbacks, is just a sign that, okay, maybe I want to be a little bit more or a little less aggressive with my stop because there's a little more chop, there's a little more up and down noise. And so, with trading, there's so much that you hear about being intuitive or just an individual skill set where it's so much the actual trader that has input into these minor adjustments. Even if you're trading a 90% mechanical system or super objectively, there's always these little things, these little nuances that help to just make little tweaks along the way. And if you think about driving down the highway, your hands are on the steering wheel and you're generally going straight, looking far down the road, but you're making little corrections. If you were to take a video of your hands on the steering wheel, you're just moving slightly to the left, slightly to the right. Maybe there's a tire in the road, so you make a correction and you move around it. So that's kind of how we're acting as traders. Is we kind of have this general direction that we're heading, and we've got this system or a method or a set of indicators or entry criteria, if you will, that we're looking at. But there's little corrections and little adjustments that we make along the way. And so that's kind of the moral of today's lesson here, is looking at the bigger context to give you some corrections that you can make or some adjustments, mainly with managing the trade, because a lot of times it's easy to find an entry that lines up with your criteria, and it's easy to throw out an arbitrary target. But in the middle, do I trade my stop super tight and be really aggressive, or do I leave it at my entry and be super conservative and risk the trade coming back and stopping me out for nothing? And that's where the experience, the time in front of the screen, looking at 1 or 2 markets for years and years and years, really helps to develop that intuition. So, as always, if you have specific questions, feel free to shoot me an email, tim@emoneymind.com. And thanks for watching. We will talk to you again next week.